Hello, my name is Edward McWilliams, partner at Cerini and Associates, here today to discuss the recently released first draft of the One Big Beautiful Bill, which serves as an outline for potential 2025 tax reform. Very important to note, this bill is not yet law, but rather has only been released in draft format, still subject to markup and several rounds of legislative voting. The first item in the One Big Beautiful Bill relates to potential Tax Cuts and Jobs Act, also known as the TCJA sunsets, which were set to sunset on December 31st, 2025. The One Big Beautiful Bill would make the TCJA individual income tax rates permanent, along with making permanent the increased standard deduction and elimination of personal exemptions. Further, the bill would call for an increase in child tax credit from 2025 to 2028 for up to $2,500 and making the credit increase permanent to $2,000, whereas it was scheduled to be sunset to $1,000 at the end of 2025. Additionally, there is an extension of the 199A qualified business income deduction set to also sunset as of December 31st, 2025, along with a rate increase to 23%, where it was previously 20%. Finally, the estate tax exemption, which was set to sunset to approximately $7 million, has been set permanently at $15 million and is set to be indexed for inflation going forward. Additionally, the bill includes several campaign promises which were done during the recent 2024 election, including a no tax on tips provision, which would allow an above the line deduction for historically tipped professions subject to an income limitation, no tax on overtime, which would also provide an above the line tax deduction for overtime premium, the half in time and a half, also subject to an income limitation, an enhanced deduction for seniors who don't itemize, which is designed to help implement the no tax on Social Security promise. And finally, an auto loan interest deduction that would allow an above the line deduction of up to $10,000 for certain taxpayers subject to income limitations. Within the bill, there are several key revenue raising provisions. First, there is a new itemized deduction limitation for taxpayers in the highest bracket, which would limit the value of itemized deductions to 35% rather than at their marginal tax rate of 37%. Additionally, there is an early sunset and termination of many energy credits, which were passed in the Inflation Reduction Act. There will be an increase in an excise tax on certain private colleges and universities based on endowment and student enrollment, as well as an increase on the investment excise tax for private foundations based on the size of their asset base. Finally, there is a renewal of excess loss limitation rules for non-corporate taxpayers and a technical change related to carryovers. Of particular interest to New Yorkers is the SALT cap, state and local tax deduction. The Tax Cuts and Jobs Act lowered the state and local tax deduction to $10,000 for both married and individual taxpayers. The One Big Beautiful Bill would increase the deduction up to $30,000 for taxpayers with an AGI below $400,000 and then phase out thereafter. Additionally, certain partnerships and S corporations can no longer deduct pass-through entity taxes, which were enacted in response to the SALT cap limitation on the business return, but rather must list them separately and would therefore be subject to the SALT cap. However, certain pass-through entities, which are 199A eligible, may be able to continue to deduct certain state and local tax items based on the current reading of the bill. All of this very much pending upcoming regulations. Other notable provisions in the bill include an increase of the 1099 threshold from $600 to $2,000 and to be indexed annually for inflation. Additionally, there is expanded use of 529 accounts for elementary and post-secondary credentialing. The bill calls for a return of a COVID-era item of a $300 above-the-line deduction for charity for taxpayers that don't itemize. The bill has a formal codification and renaming of individual coverage HRAs, which allowed taxpayers to purchase health insurance on the marketplace with a reimbursement from their employer, renaming them from the individual coverage HRAs to choice accounts. And finally, there will be no refunds or credits for ERC claims submitted after January 31st, 2024. As we stated, this bill is still in its early stages, subject to many rounds of legislative change and votes, and is nowhere near law yet. However, this does provide us with an outline to help to begin to understand what potential 2025 tax change may look like. As we continue to get more information, we will continue to push out more information and be able to react and start to plan once we understand exactly what changes will ultimately become law. Thank you for your time.